Michaela has a question in the Q&A section that I want to get to. I think it's pretty good. She's a couple, and I think it's along the lines of, well, it is along the lines of this. She's got this duplex that she's been chipping away at renovating. It's pretty much done, a couple cosmetic things. And her question is, she wants to refinance. She doesn't know if she should get everything done first, take the time and then refi or refi now, take that cash out. You're talking about flipping, selling. Does anything change in your advice around if you were to kind of flip it whole, like Burr, essentially? Is anything change in that?
So completely different strategy. So one, let's talk about rentals in general. So with rentals, I like to say at this point in the cycle, plan for a 10% drop in rents. I know back in 2008, there were a lot of markets that saw no drop. There were even markets that saw an increase. But if you look across the country, pretty much the worst case drop in rent in most major markets was about 10%. Yeah. And so if you're running a pro forma on a new rental property or a new multifamily property, assume your NOI or assume your gross rents, not necessarily your NOI, assume your gross rents are going to drop 10%. Assume your vacancy might increase up to 10%. And again, a lot of places saw no vacancy increase back in 2008. Some were flat, but worst case scenario was that some B and C class properties saw up to a 10% increase in vacancy. So model that in. If you're running a pro forma for a rental property or multifamily right now, run a risk scenario where you see a 10% drop in vacancy or a 10% increase in vacancy, excuse me. Yeah. And make sure it still pencils out for you, or if you have investors, for your investors, and make sure you're willing to accept that worst case scenario. Another thing I like to tell people, if you're buying buy and hold right now, whether it's a Burr or multifamily or house hack, whatever it is, focus on lower class properties, because what we see is we tend to see a lot of rent compression during a recession. So
A-class, B-class, yeah.
People move out of A class into B class, C class moves into mobile homes. So what you see is at the top of the market, rents tend to drop a lot more. In the A class, rents tend to drop a larger percentage than in B class. In B class, they drop a smaller percentage. C class, They drop, and you see this compression of rents. Yeah. And so what I tell people is don't necessarily focus on A class unless you have a longer time horizon and a higher risk profile. Nothing wrong with focusing on it, but just know the risks. Same with B class. B class, you're going to have a little bit higher risk profile, and you might want to model out your pro forma to 5 or 7 years as opposed to 3 or 5 years. If you're doing C class, you're probably a little bit safer. If you're doing mobile homes, you're probably a little bit safer. But just understand that with different types of housing, the risks are different. And again, you can look at the data for your area and for that type of housing, see what happened in 2008. And that's probably your worst case scenario. So getting back to Michaela's specific question about refinancing now. So there's good and bad with a recession. From an investment standpoint, typically during a recession, interest rates drop. Lower interest rates are good, but banks tend to get a lot tighter with their financing. Large institutional banks, Fannie Mae, Freddie Mac type loans, they're a lot tougher to get, especially if you don't have a job. Portfolio lenders a lot of times will stop lending on flips completely. Or at least if you go back to 2008, I wasn't in real estate before 2008, so I don't know what happened before 2008. But you look at 2008, portfolio lenders stopped lending on flips completely, and they culled their rental lending a good bit. So what I would ask Michaela is, one, what is your current refi strategy? Are you planning to refi with a big bank, a conforming loan, a Fannie Freddie loan, or are you looking to work with a portfolio lender? Number two, I would say, what does your financial situation look like? So if you are you and your husband potentially in a position where you might lose your job if the economy turns? Are you thinking about quitting your job? Are you in an industry where you might have to take a big pay cut? If so, that's going to impact your financial situation if the market turns, and it's going to impact your ability to get a loan. So definitely factor that in. But if you're in an industry or in a job that you're really secure, you know that you're not going to see a big pay cut. You're not going to get laid off. Your company's not going to go out of business. And you're planning to, and your credit score is over 720 or 740, and you're planning to work with a big bank, then there's probably a whole lot less risk than if you have a 680 credit score, you work in an industry that could get hit hard, and you're planning to work with a portfolio lender. So these are the questions you need to ask yourself. It's just basically, it's just risk management and what you think the worst case scenario is. It's always at this point in the cycle, it's what's the worst case scenario and can I weather it should that scenario actually play out? Okay. So I can't answer the specific question without knowing more, but those are the questions that if I were Michaela, I'd be asking yourself.
That's fair. No, I want to be respectful of you. It's 9 o'clock right now. If you got to go, I get it. If we got a few more minutes, I got one or two more I'd like to squeeze in if that's cool.
I had 8 to 10 on my calendar. So as long as you want to go.
All right, everybody ready for some OT? I'll take some comments on that, so we'll get a little more of Jay.
I'm sorry, I thought this was 2 hours. Otherwise, I wouldn't have been so long-winded on everything.
It's great, man. It's great. Whatever. My kids are asleep now. My wife is probably getting a drink for putting them both down. So we're ready to go. So for one question I'm curious about debt coverage. Actually, I had this question from an investor. From a debt coverage ratio, what are you looking at? What do you think investors should look at, or should they even be considering any level of debt coverage beyond what the banks require, 1.25 or so? But would you say if you're buying an asset right now, a multifamily asset, you should be hedging toward a 1.6, 1.7 debt coverage pro forma or actual at purchase? I don't know if that makes sense, but I'm looking for some sense of that.
So again, there's no right answer for everybody. So I guess I would ask the question of, is this a property? Everybody should be asking themselves the question, is this a property they're buying personally? And what do their reserves look like? If they have investors, how do those investors feel about potential capital calls? If they get into a situation where vacancy increases or rents drop. And typically speaking, I like to, for my multifamilies, I like to run pretty lean and not have a ton of reserves, but that's because a lot of times I'm buying with my own money and I have partners who have money and we know that we can pull money out of other projects. Sure. If I were in a situation where I didn't have any other money or I had investors that I knew couldn't handle a capital call or would just riot in the streets if I asked them to put more money into the project, then I'd be more conservative. And again, I like to model, and this is on average. You should look at your market from 2008 and see what happened. But on average, I like to model 10% drop in rents, 10% increase in vacancy, and then still shoot for that 1.25 DSCR. Okay. So if you can keep 1.25 even with increased vacancy and lower rent, I think you're pretty safe.
Okay. I think you answered. I got a couple other questions that were posted in the Facebook group. I think you answered. Where do you see the most economic growth in real estate, short, long term, or is it short or long term? Or no, I'm sorry. Where do you see the most economic growth in real estate in the short term and in the long term? Maybe I don't know if you have any thoughts on that.
I think, typically speaking, and here's another kind of misnomer for a lot of us that started in real estate, and I would certainly think this if I didn't study this more than most people, but a lot of people I talk to think that real estate is kind of what causes recessions. They were around in 2008, and I hear a lot of people say, oh no, the economy's strong because I'm seeing like housing is strong in my area and inventory is still low and prices are going up. And what a lot of people don't realize is there's two things. One, housing is typically what we call a lagging indicator. Mm-hmm. Typically, the economy changes before housing starts to change. The economy will start to downtrend before housing takes a hit. Okay. So if you're looking just at housing, you're probably a quarter behind. So 3 months behind where the overall economy is going. Now, in 2008, this was different because 2008 was a recession that was caused by real estate. It was caused by bad lending practices. It was caused by over-leveraged banks. But that's not typically the case. You go back to 2001, and it was tech and 9/11 that caused the downturn. You go back to the late 80s, it was the savings and loan crisis. You go back to the 70s, and it was oil. You go back to the 30s and the Great Depression, and people don't like to hear this, but the thing that caused the Great Depression, one of a half dozen things, but a big factor was tariffs. And so there's something different that causes every recession. And just because we all remember 2008 because it was so bad and so recent, we all tend to think that look at real estate and that'll tell you where the economy is going. But it's actually the other way around. The economy leads, real estate lags. So that's the first thing. Second thing is I like to look at real estate and the economy seasons. Not every live in Buffalo, your weather is going to be different than if you live in San Diego. It's going to be warmer in San Diego than Buffalo. But when winter comes, everybody's temperatures are going to drop on average. So when you go into a recession, I know there are people that think my city is going to weather a recession and prices are going to keep going up. Typically speaking, that doesn't happen. Now, you might live in a San Diego, in the analogy, where during a recession, your housing prices don't go down much. Maybe they drop 1 or 2 or 5%. You might live in another market where they drop 10 or 20%. But pretty much every market during most recessions is going to see some downturn. And that's not necessarily because the fundamentals of real estate are bad. People were like, well, the banks aren't over leveraged this time. Yeah, it doesn't matter. The thing is, if people are losing their jobs, it doesn't matter how creditworthy banks are and how many loans they want to give out. People can't get loans. And if wages are going down, people can't afford the same amount of house. So housing prices are going to go down. And so there's just this thing that during a recession, you have to accept the fact that for the most part, 95% plus percentage of the country is going to see lower housing values. They're going to see higher inventory. They're going to see fewer buyers. And so if you ask, where do I see growth, short-term, long-term? Short-term, I don't see a lot of growth because short-term, and again, I don't know if it's a month or a year or 2 years, short-term, I see a downturn. So I think there's going to be, real estate's going to get hit. Again, I don't think it's going to be like 2008. I'm not trying to predict, but I don't think it's going to be like 2008 downturn. But I don't think we're going to see a lot of growth through the next recession. After the next recession, I don't know. The whole world tends to change so quickly, and I know people like to make predictions. So I don't know what the next trends are. I couldn't have predicted back in 2006 that millennials would never want to buy a house after a recession. I mean, I think everybody would have predicted baby boomers are going to kind of move into retirement homes and die off, and millennials are all going to go and they're going to be the largest house buying segment of the economy in history. So what we saw was just, it's one of those you can't predict. So it's a tough question. I don't think I'm smart enough to answer.
You're smart enough to answer. I think you answered another question by doing so. There was a question here about most recessions not affecting the housing market, which, I think you kind of explained it a little better. It's not that a recession equals housing market or housing market equals recession. It's that the housing market lags the recession or the right kind of thing. So the question was, why do you think the next recession might affect home prices like the last one? I don't think you ever said it would affect it like the last one. But the impact, as you mentioned, was if wages compress, if unemployment goes up, if people don't have the buying power to buy, then naturally housing prices come down, right? It's just the way it is.
Yeah, I don't think the next recession is going to be driven by real estate. I don't think real estate is going to cause the next recession the way it caused the 2008 recession. But when the downturn comes and people lose their jobs and get paid less and all that, every sector of the economy is going to suffer because people have less money.
All right, I'm going to keep going just for another. I said two more, but I'm going to ask a couple more. You guys,
you and everybody wants to stay on, I'm good.
I'm good too. So whoever wants to stay, please do. But there's been two questions now about interest rates, and I feel like it's an elephant in the room that we haven't talked about yet. One of the questions was Mark Williams. I don't know which one. We have two of them in the group. What do you think about the Fed going to 0%? And there was another question about potentially going negative with interest rates. So if you want to spend a moment on interest rates and just that topic, I think that would be really powerful.
Yeah, absolutely. And this has been a big topic. I wrote a couple really long Facebook posts on this recently that started a lot of great discussion. Okay, so a little bit of history again. Typical recession. So what causes a recession? So what causes economic cycles? The big two things are inflation and interest rates. So when the economy heats up, people start spending lots of money. Businesses start spending money to produce more stuff. When people buy more stuff, businesses produce more stuff. They hire more workers. They pay their workers more. They give them big bonuses. People have lots of money. They start spending money. And businesses say, okay, well, I have to produce more. So they start buying more equipment. They start buying more factories. And when that happens, things get expensive for businesses. So they start raising the prices of their stuff. Mm-hmm. And raising prices of their stuff that's what we call inflation. And so a really good economy leads to inflation. That's just the way it works. And inflation is just a byproduct of an awesome economy, businesses making lots of money, their employees spending lots of money, and just the snowball up. Okay, so when we start getting this inflation's bad, obviously, because people can't buy as much. Things get more expensive. Their paycheck doesn't go as far. So basically, that's when the government steps in and says, okay, we're going to stop this inflation because this is really bad for our country. And what do they do to stop this inflation? Basically, that's the Federal Reserve's job. And they have two ways of doing that. The first is they can print more money. So you print more money, you put it out there, everybody has more money. They don't like to do that. That's kind of a last resort. So the thing they typically do is they play around with interest rates. Right. Now, when the Fed increases interest rates, what does that do? Well, it does two things. One, because you make more money in your savings account or in your CD or in bonds because interest rates are up, people start to save more money. Secondly, because interest rates are up, your credit cards are charging more and your lenders are charging more, your mortgages cost more because the interest rates are higher. So borrowing money is more expensive. So between saving, gaining you more money, and borrowing costing you more money, when the Fed raises interest rates, people save and they stop spending. Mm-hmm. And what's that do? That slows the economy down. So that's what the government does when the economy is really strong and inflation starts to take hold. They raise interest rates to slow everything down. Now, when things start to slow down and the government says, oh no, like it's a recession and we need to spur the economy, need to get people to start spending more, they do just the opposite. They lower interest rates. Mm-hmm. So if you're getting 1% in your savings account, you're like, oh, I'm going to go buy that new car because I'm not getting any money by saving. And when interest rates are at 2 or 3%, and you're like, oh, I can go buy a house because I can get a 3% interest rate. You're like, I'm not saving my money. I'm going to go spend. So lowering interest rates spurs the economy and gets people spending. So when we go into a recession, we start into a recession, the government is going to lower interest rates to kind of spur the economy on and get things moving again. This leads me to the point I originally wanted to make was historically, from the beginning of a recession to the end of the recession, government's going to drop interest rates about 5 percentage points. So that's how far on average the government needs to be able to drop interest rates to spur the economy to get us out of that recession. Mm. Historically, every recession we've gone into, interest rates have started at above 5%. Right. So you start at 8% and you drop 5%, you're down at 3%. Yeah. 2008, we started around 6% and we ended up at about 1% or close to 0%. But we've always started above 5%, giving us what I call enough runway to lower interest rates and spur the economy out of the next recession. Well, what happens when right now we're at interest rates of 2%? And when we talk about these rates, we're talking about what's called the federal funds rate. And that's the rate at which the government lends to banks so banks can lend to people. So we're at about 2%. If a recession started today and the government needed to lower interest rates to spur the economy, if you want to take the historical metrics, the government would have to lower interest rates to about -3% to get us out of the economy, out of the recession.
Out of the recession, right.
So that leads a lot of people, especially a lot of economists right now, to say, we're in a bad spot. We're in a very precarious situation because we're in what's been a historically very strong economy. We're still relatively strong. I think nobody's going to say that we're not at least relatively strong still. And yet we have interest rates at 2%. Mm-hmm. And so when the economy turns, we're in a really bad spot because there's only so much we can do. Now we can go to the second piece of that puzzle. So the Fed can also tell the Treasury to print money. And that's the second piece. And we did a lot of that in 2008. It was what was called quantitative easing. And we started printing a ton of money. But printing money has its own problems. So it is probably what we would have to do if the next recession started tomorrow. We'd lower interest rates to near zero, and then we'd start printing a lot of money. But that causes other problems. You hear Trump complaining that China is manipulating their currency. Yep. That's a fancy word for they're printing money. Mm-hmm. So we talk about how manipulating currency or printing money is bad. And it's true. It is. That's not a good thing. But it would be just as bad if we started doing it. The problem with printing money is it pisses off your trading partners. It pisses off the countries that you do business with because it throws off the value of trade. Right. And I'm not going to go into the details there, but long story short, when you start printing a lot of money, those who are buying from you are not going to be happy because they're paying relatively more because the value of their currency is dropping compared to yours. Wow. So printing money is bad. The other thing with low interest rates and printing money is investors stop trusting you. So right now, the reason the government's able to borrow as much money as it is because you go to Europe, you go to Japan, interest rates are negative, which means if somebody buys their bonds, if they're lending money to the government, they're literally getting no return. So where's everybody coming? They're coming to the US because here you can still get 1% or 2%. That's huge returns compared to other places. If we drop interest rates to 0% or negative, people are going to stop investing here. And when our trading partners see that we're printing lots of money, they're going to lose confidence in us. And so it's a really bad spiral when interest rates get towards zero and the economy's heading towards a recession. It's just a really bad combination.
Have we ever hit, I don't even know, have we ever hit zero, or we've never gone negative?
We've never gone negative. I think we got really close to zero. We may have even hit zero in 2010, 11, maybe. I don't think we did. We got really, really close. Sure. We've never gone negative. But a couple countries, so Germany is one, Japan, Denmark, they've gone negative the last few years. What does that mean? Well, I mean, it means what it sounds like. If I loan you money at 5% interest, you're going to pay me back the amount of money that I lent you plus an extra 5%. If I loan you money at negative 5% interest, you're going to pay me back 95% of what I lent you. Right. As a lender, I'm not even getting back all of my money. So that's not good. Are you going to put your money in a savings account? Are you going to put $100 in a savings account when you know you're only going to get $98 back at the end of the year? No. And so that's the risk. Now, it's good if you're an investor and you're buying houses because you buy your houses at 1%.
1%. I was going to say, I'll buy a house at 1%.
Right. But most Americans aren't investing their money. Most Americans are just trying to get by. Yeah. And when they start seeing that the money they have in the bank is losing money, they're going to lose a lot of confidence. And so negative interest rates is really, really bad for banks. We'll see some major bank issues if we go negative on rates. And it's going to mess up the economy in a whole lot of ways. And I would say anybody that wants to follow me, I'll throw out later my Facebook username. And I've written a whole bunch about negative interest rates on my Facebook page, a couple articles. So if anybody wants to follow me on Facebook and read those, they can.
That's unbelievable. I'll tell you, I have a page full of stuff. I don't even know if it's organized at this point, but I thought I knew some stuff. It's clear I did. Like the yield curve discussion alone was worth I should have charged for that, people. That was unbelievable. That was an incredible explanation, except for I think Mitchell knew all of that, although he just left. So you can't even hear me say that. But
by the way, you asked earlier and I pitched something and I didn't answer your question. You asked, where can people find this data?
Oh yes. Sorry.
So that's the really cool thing. People always ask, so like, what are you reading? What are your sources? And if you would have asked me 10 years ago, I would have said Wall Street Journal, Financial Times, Business Week, all those magazines. These days, literally, I follow some really smart people on Facebook, people that are into the stuff. And every morning I get up and I go through my Facebook feed and I read all the articles that they've posted. And they're posting articles from Wall Street Journal and Business Week and Financial Times and all that. So it's the same thing, but I don't have to subscribe to these magazines or these papers. It's so nice that like just follow smart people out there on Facebook or whatever social media you use or whatever groups you're using. And I go into Reddit. So anybody that's on Reddit, they have an economics subreddit, what's called a group. And I mean, you can read all this stuff. If you're looking for specific data, there is a website. If you type into Google St. Louis Fed or FRED, Fred, and it's basically a site where you can type in any keyword like GDP or wage growth or interest rates, and it'll show you graphs, like all the historical graphs. It's the Fed data from the government all the way back to the 50s. And so you can basically see the trends over the years, and you can also see where things are right now.
St. Louis Fed or Fred?
Yes.
Fred. Okay.
So great. St. Louis Fed or space Fred. For some reason it's called Fred, but it's the St. Louis Fed.
Okay. No, that's great. That's great. Again, unbelievable information. I can't thank you enough, honestly, for providing us with this. This is so on point right now because this is like this bubbling up topic. everyone has an opinion, everyone has a thought about it or whatever. What I like about your approach is it's data centric, right? You're just looking at, this is what the data says, this is what history says. I'm combining this to say, here's what I think. But nobody really knows for sure, but I tend to agree. I mean, as much as I know, that it feels like we're at a top. We're a little toppy, if you will, right now. And what happens next, who knows? Like you said, we could stay kind of horizontal for a while, or tomorrow we could hear about some catastrophic news. So
I think part of the problem these days is there's so much emotion tied up with the economy because of politics. And I hear so much bad information because people are conflating politics and the economy. And what I would just recommend to people is try and take emotion out of it. Look at the data, come to your own conclusions. Don't listen to Fox or CNN, because they're both trying to convince you that something's happening. Look at the data, take the emotion out, don't listen to anybody else, and come to your own conclusions. And that's just my best advice.
Unbelievable. Yes. Great way to put it there. Amen, brother. It says take emotions out of it. So Jay, where can people learn more about you, find you, social media, anything like that, get in touch with you, whatever it may be?
Yep. So let me throw this out. So about 3 months ago, my wife and I started a new podcast for Bigger Pockets. We started Bigger Pockets. Everybody probably knows about the real estate podcast. They also have the money podcast, which is focused on personal finance. We recently launched the Bigger Pockets business podcast. So my wife and I every week talk to entrepreneurs and business owners, and basically we delve into their stories and best practices for entrepreneurship and starting businesses. So really excited about that.
That's cool.
So check that out. We've had some really awesome guests, and anybody that wants to find me on Facebook, because I threw that out a couple times, J Scott Investor is my username. So Bigger Pockets, Facebook / J Scott Investor. And then my website's 123 Flip. And if anybody wants to send me an email, j@jscott.com.
Wow. Beautiful. That's incredible. Thank you for all of that. The book again, Recession Proof Real Estate Investing, that's out. Amazon, Bigger Pockets, you get on either one, I'm assuming?
Either one.
And the other book, the book on flipping houses, same thing. I searched that one for sure. I know that's on both platforms. So look it up, find it. This will be on YouTube. Share this with people. This is information that people need to hear and need to know. Man, this is just a wealth. I'm excited about this, man. Thank you so much. I can't tell you how much I appreciate it.
Melody, thank you for posting the link to the St. Louis Fed.
Oh, perfect. I didn't see that. That's awesome. And yeah, there's a bunch of comments in here that if I missed a question here or there, I do apologize, guys. I want to make sure I respect all of your time. And I know, Jay, you buttoned up the 2 hours or whatever, but with everybody on here, I figured I'd give them the bonus of 20 minutes or so, but we'll call it. But man, thanks again. I really appreciate it. This has been really, really fun, really informative. And I'll be following you on every platform.
Well, let's come back in 6 months and do a follow-up and see where everything is then.
I love that. I'm going to take you up on that, because I think that will be awesome. So I'm going to take you up on that. I appreciate it. Thanks, everyone. Thanks again, Jay, and have a wonderful evening.
Thanks, everyone.
Bye-bye.